How do credit spreads work?
That's what we're going to be going over today in today's video. And also, we're going to learn how we can come join that Theta gang and get that free money. Um, just like we did earlier today in the small account challenge, we were utilizing a credit spread, particularly the put credit spread. That's what I'm going to go into detail in today's video. So everyone, this is a brand new channel, and I would really appreciate it if you guys could hit the subscribe button, the notification button, and give these videos a thumbs up. It would be extremely helpful, and I would be forever grateful if you guys could go ahead and do that for me, especially since this is such a small channel just starting out. It would be immensely great. I would be immensely grateful for that. So if you could go ahead and hit the subscribe button and like the video, that'd be great. So the next slide here is a snapshot of the chart that we had at the end of the day. So what we traded was the SPY ETF. We were trading options, and we traded a put credit spread. So the concept behind a put credit spread is that you're selling an option with added protection. So basically, when it's all said and done, the nuts and bolts of the strategy is you're selling a put and then you're buying a cheaper put. And so here that is represented with the green dashed line and the red dashed line. The green dashed line represents the naked put that we are selling, and the red dashed line represents the cheaper put that we're purchasing for protection. So for a put credit spread, you're just selling a put while also buying another put for protection to limit your downside. You're selling one put while you're also buying a cheaper put, and your profit is the difference between these two puts. So the extra premium that's left over after you're buying the cheaper protective put is your max profit, which comes in the form of a credit, which also therefore gives the name credit spread. You generally sell a put if you think a stock is going to go up. So you sell a put credit spread when you have a bullish take on the stock, thinking it's going to stay above the strike price that you sold your put option for. What makes this so appealing is that while your upside is obviously lower, your downside is also greatly reduced. So it goes from being, having 100% downside, because if you were to sell or buy a regular put option, you have the opportunity to lose every last cent that you put into that put option. But when you buy a credit spread, you limit and reduce your downside. So while your upside is obviously lower, your downside is greatly reduced. And it goes from being 100% downside if you're selling a cash covered put to having a limit, and one that you can have set depending on how aggressive you want to be for your profit target. So if you're selling a naked put on margin, your potential downside is absolutely enormous. It is huge. So for example, when we look at our deal here, we'll say we received a $25 credit. So with this credit spread, so there's a difference of $1 between each strike price, and each contract gives you the right to buy 100 shares. So we multiply the $1 by 100. So our total cost of the trade is $100, but we received a $25 credit. So we have to put up an additional $75 as collateral or margin to take up the entire $100 cost of the trade. So we received $25, so we should be putting up $75 in collateral. As long as the stock stays above 284, the put option that we sold, we get to keep that contract, or we get to keep the credit of $25, and our $75 of collateral gets released back to our buying power. So then we use $75 to make $25, which in theory is a 33% profit on that single trade. Understanding, the possibilities and, understanding where the stock is important. Understanding where it could be moving is important. because you're going to use all of that as a form of management for risk. So with that being said, there are some potential mistakes. So some potential theta gang mistakes. You don't want to end up like this guy looking at your Robinhood account, sitting in a windowsill with some things strapped around your neck and pointed at your head. That is not where you want to go. So to avoid the mistakes, you must know the mistakes that are possible to make. So first one is making the credit spread too small. If you pick strike prices on the puts that are too close together, you'll get hardly any profit for the capital that you're risking, putting up for collateral. To avoid this, I'd recommend estimating the yield of your credit spread based on how much capital you're risking and how long your capital is tied up, the expiration date. If it's too small of a yield, either don't take the trade or buy a cheaper put or sell a more expensive put. So that's how you kind of go around making the spread too small. Second is setting up your protective too low. If you pick a protective put that is too far out of the money and that only a black swan event would provide you a sort of protection, well, you're risking a lot more downside risk than getting yourself into selling a naked put territory. If you sell a protective put that is so far out of the money that only a black swan event would provide any sort of protection, well, you're asking for a lot more downside risk and getting yourself into selling a naked put territory. In fact, we'd probably argue at that point, you're just throwing your money away on protection, like if the underlying stock needs to drop 20% or something crazy. You can be aggressive when it comes to setting your credit spread, but don't be greedy. I mean, it goes back to the old adage, bulls make money, bears make money, theta gang makes money, but pigs get slaughtered. So the third, not setting a profit target. When you have a profit target of, say, 50%, you're able to capitalize on either swings of the stock and or time decay. So that's what we did earlier. We reached a profit that was far over our profit target, and so I closed it early. Instead of waiting the few minutes remaining in the day, waiting for a crazy drop, crazy sell-off in the last 45 seconds, 2 minutes of the day, I secured it. I locked it in. I wanted to capitalize on the profit that we achieved. So I don't want to get too detailed here, but essentially, there's gamma risk and tail end risk that can increase after you've hit your profit target. So why greatly increase your risk to double your money from 50 to 100% when you can at least take 50% and stop taking those risks? 50% profit target seems to be a really good one. I like to have it. It's comfortable for me. I do, wish I could max out these profits, but I also want to live to see another day. I don't want to blow up my account. The fourth, not doing the due diligence on the stock. This should go without saying, but you need to do your due diligence on the stock and investigate and research and chart and understand how the stock is acting so you can develop a forecast of where you think the stock is going to go. It's almost thought of as an afterthought to a lot of people, and I'm a victim of this. I've blown up, an account of actual money, which was atrocious, which is another reason why I'm going on this education journey and using paper trades, because I learned with actual money. And so I want to develop an education and I want to develop a good foundation of strategy with paper money before I, start putting in actual dollars again. And so, I fell victim to this, and, the analysis of the stock wasn't my first step. It was what could I afford and what was easiest to get filled in Robinhood. And that was dangerous. And so moving to, TD and using ThinkorSwim allows me to have the research tools and the charting tools to really understand resistance and charting and get a better grip on the analysis side of what a stock is doing and where it's heading. And this is, one of the most important things now. And so the last one would be not checking the volume. So liquidity is always something you should consider when you're trading your options. especially when trading theta gang spreads. If you're setting profit targets but trading options with low volume, then don't expect your trades to be filled when trying to exit. You need more volume when you want to close a trade right away. That way you can secure profits at a quicker rate rather than submitting an order and letting it linger for a few minutes or even half of a day and letting the price of that credit spread go up and down. Option chains post the volume of the contract that day, so check to make sure that there's a decent activity before entering the trade if you're expecting to get out and take profits from the table later. So that really wraps it up. That gives you kind of a good understanding of put credit spreads and kind of uses the example that we used for our small account challenge that's also on the channel. So go ahead and check that video out. There's going to be 2 videos posted already. Episode 1 and 2. So we had some exciting activity that you guys might enjoy. I look forward to seeing you guys in the next video and happy trading.